valuation and related provisions. What are we going to cover in today's session? Many things. All of you, if you have to start your journey of valuation, the best thing that you can do is to start your journey with good understanding of India's 113, which is on fair value measurement, followed by valuation standards. There are many valuation standards all over the globe, but you do not have to really read all of them. And why you do not have to read all of them? Because most of them are on the same lines, same contents. What you can definitely read is the valuation standards brought out by IVSC, that is International Valuation Standards Committee, and the valuation standards brought out by the Institute of Chartered Accountants of India. Then we will talk about the valuation conundrum. Friends, my objective in this program is to explain valuation in such a way that not only you are able to understand it very clearly, but you are also able to apply it from the very beginning, from tomorrow itself, as much as that. I will also share with you what are the opportunities which are available for valuation professionals, what are the different types of valuation professionals, and which of those categories all of you can apply and start practicing. Thereafter, we will understand the business valuation process, some of the purposes for which the valuations are carried out, the approaches and the methods for valuation. So obviously, if you have to do the evaluation, you have to follow a method, you have to follow an approach. What that approach can be, what that method can be, that is what we will understand. We will also cover techniques of different types of corporate restructuring and importance of valuation in case of corporate restructuring. Thereafter, we would be looking at certain provisions under the Companies Act, Insolvency and Bankruptcy Code, and in the Income Tax Act, and also the rules framed by the IBBI relating to valuation. So what are the prominent, important, relevant, pertinent provisions under the Companies Act, IBC, Income Tax Act, and the rules framed by IBBI? That is what we are going to look at. And in the income tax, my focus is going to be on Rule 11U and Rule 11UA. I am sure many of you must have heard of Rule 11U and Rule 11UA under the income tax rules, and you must be quite aware. It's going to be my endeavor today to explain Rule 11UA1CB in such a way that, again, in case in your firm or in case of your company, if anyone has to do the evaluation as per Rule 11UA1CB, you should be able to very easily do it, and that is how I intend to discuss and cover this topic with you. We will also talk about, because when you are a valuation professional and you do the valuation assignment, it is very important and critical that you must do proper documentation and also prepare a valuation report which is comprehensive. So what are the things that you need to take care in respect of the valuation report? That is what we would cover. And finally, friends, remember, valuation as a profession is not another stream of cash flow for the practicing professionals or for the working professionals for that matter. It is a tool. Valuation rules are a tool for bringing or enhancing the level of corporate governance in this country. And therefore, we would also be looking at the model code of conduct for registered valuers. So this is the plan that we have today for our session today. From time to time, I am not able to see all of you because my screen is being shared with you. But at any point in time, in case if you want to raise a question, raise a doubt, raise a query, you can of course unmute yourself and you can ask me that question. Depending on the question that you would ask, either I will answer it then and there only, or in case if I am going to cover in my following presentation, then I would ask you to wait for some time and get you when you will get the answer about it. So where do you start your journey from? You start your journey about valuation from good understanding of Ind AS 113. I am sure, friends, by now all of you must be quite well aware of the Indian accounting standards, as many of you are working with listed entities. Therefore, you will also know that as far as listed entities are concerned, their accounts need to be prepared following the Indian accounting standards. Indian accounting standards, Ind AS as we call them. Within Ind AS, there are total today, as it stands today, there are 39 different accounting standards, Indian accounting standards, that you as a listed entity have to follow, or an entity whose net worth is more than 250 crore, you have to follow. And then of course, also the entities, the entities of a listed company or any entity to which Indian accounting standards are applicable. The holding company of such company, the subsidiary company of such company, the joint venture of such company, the associate of this such company, they also need to prepare their accounts following the Indian accounting standards, and that is what we need to be aware of. So for the purpose of valuation, we need to have good understanding of Ind AS 113, which is on fair value measurement. And as I said earlier, we also need to have a good understanding of the valuation standards. Let me just give you some idea about the Ind AS 113. So first of all, please remember Ind AS 113, which is on fair value measurement, it does not mandate any particular technique or method or approach. So Ind AS 113 does not say that you have to follow this method in this situation, follow that approach in that situation. No, it does not stipulate any such technique, method or approach for a particular situation. What it talks about three different approaches of valuation. And what these three different approaches of valuation are: the first one is known as income approach, the second one is known as market approach, and the third one is known as cost approach. I am sure a question must be coming in the minds of every one of you as to how do you differentiate between these three approaches, number one, and number two, as to how an income approach is known by the name income approach, and why a cost market approach is known by the market approach, and why the cost approach is known by the cost approach. Answer, of course, is very simple. When you are using income approach for the purpose of a valuation of a company or an entity or in any other situation, and you are using income as the basis for the purpose of arriving valuation of that entity or that company, that is known as income approach. So when the information about the income is the basis for the purpose of valuation, it is known as income approach. When the market information is the basis for the valuation of an entity, it is known as market approach. And when it is the cost or the value of the assets that you are trying to value, that is known as cost approach. So these are the three approaches which are prescribed in the Ind AS 113. And as I said earlier, remember, there is no mandatory method or the approach that you have to follow. Another thing about the Ind AS 113 is it does not mandate any method or approach, but it certainly talks about a valuation hierarchy, fair value hierarchy. And what this fair value hierarchy is, this fair value hierarchy is the Ind AS 113 talks in terms of level 1 input. So what does it mean? It means, it says, Ind AS 113 says that if you have to do the evaluation of an entity and that entity is listed on the stock exchanges, in that case you go for the level 1 input, and the level 1 input would mean quoted price of that entity. So you are trying to do the evaluation of Maruti or L&T or Hindustan Motors or any other listed company for that matter. So the Ind AS 113 says that for the purpose of valuation of an entity which is listed on a stock exchange, You do not have to go here and there. You simply pick up the quoted price, and that quoted price becomes the basis for the valuation of that company. Then it talks in terms of label 2 input. Now, what is label 2 input? Please remember, in India or anywhere in the world, it is not that you have all the entities which are listed on the stock exchanges. You have certain entities which are not listed, not certain, many entities or most entities which are not listed on stock exchanges. And it's not that you have to do the valuation only of the listed entities, you also have to do the valuation of unlisted entities as well. So therefore the question is that if you have to do the valuation of an unlisted entity, how do you do the valuation of unlisted entity? The India's 113 prescribes label 2 input. And what is label 2 input? Label 2 input would mean the observable information. Observable information. That means what? That means you are trying to do valuation of XYZ Limited. XYZ Limited is not listed on a stock exchange, but there is a company called ABC Limited which is listed on the stock exchange, and ABC Limited and XYZ Limited are similar in many respects, and therefore label 2 input would mean that you take the valuation of ABC Limited and make use of the quoted price of ABC Limited for the purpose of doing the valuation of XYZ Limited that you want to do the valuation, and that is your label 2 input. Then there is a label 3 input. Now what is label 3 input? Label 3 input is, number 1, there is a company which is not listed, and number 2, there is a company which is not only it is not listed, but there is no company which is of similar type listed on the stock exchanges. Then the question is, then how do you do the evaluation of such a company? Because quoted price is not available, comparable or the observable data is also not available, but you still have to take a decision about this company. So how do you do the evaluation of this company? And the India's 113 talks in terms of label 3 input. इसका क्या मतलब है? इसका मतलब ये है that you create your own input. You create your own information. Meaning what? Meaning you want to do the evaluation of XYZ. There is no XYZ is not listed on the stock exchange. There is no company, comparable company available which is like XYZ Limited. So now how do you do the evaluation? You do the evaluation by using the unobservable data. That means what? That means you create your own information. Meaning what? Meaning XYZ का आपको वैल्यूएशन करना है तो आप इसके प्रोजेक्टेड फाइनेंशियल स्टेटमेंट्स तैयार करो, प्रोजेक्टेड कैश फ्लो तैयार करो, और वो प्रोजेक्टेड कैश फ्लो को डिस्काउंट करके उसकी प्रेजेंट वैल्यू निकालो, एंड दैट प्रेजेंट वैल्यू बिकम्स द वैल्यू ऑफ दैट XYZ Limited which is not listed and not having a comparable company as well. So that is your India's 113 and label 1 input, label 2 input and label 3 input. Let's now shift our attention to the valuation standards. As I mentioned to you, what for your understanding and for your reference, it is good enough for you to have a good understanding of the valuation standards as prescribed by IBSC and as prescribed by ICAI. Now remember, gain sound understanding and then follow the evaluation standards for a comprehensive understanding of valuation framework and successful completion of valuation assignment. So if you want to become a successful valuation professional, if you want to excel in the domain of valuation, this is what you have to do, and that is you ought to have good understanding of the valuation standards. Fortunately or incidentally, friends, all that which I have prepared in this session that I am delivering for you, the entire thing is based on the valuation standards as prescribed by IBSC and as prescribed by ICAI. So therefore, naturally you are getting a good understanding through this presentation or through this session about the valuations. Now, why do we have to look at the valuation standards? The first objective of the valuation standard is to enhance the reliability and accuracy of valuation, right? Number 2, to ensure that the valuation reports are standardized and transparent. And number three, to protect the interests of stakeholders by providing an objective assessment of asset values. So these are the three objectives for which we need to have good understanding of valuation. Just to give you some input on the valuation standards, if you look at the valuation standards brought out by the ICAI, you will see there are all put together 8 accounting standards. All put together, there are 8 accounting standards. And when you look at the valuation standards brought out by the IBSC, you will see all put together there are 15 accounting standards. 15 accounting standards. So meaning what? Meaning there are 7 standards, valuation standards, which are different, which are additional to the ICAI valuation standards, and that is IBSC will talk about scope of work, data and inputs, valuation models, and it will also talk about these 5 categories of assets which are not there as part of the standards brought out by ICAI, and that is because non-financial liabilities, inventory, plant, equipment and infrastructure, real property interest and development property, I am sure you can understand these 5 categories of assets do not belong to the financial assets, and that is why for these 8 categories there is a valuation standards which is in IVSC and not in ICAI. So remember, the valuation standards brought out by ICAI are meant only for the valuation professionals who are practicing in the domain of financial assets and securities, whereas IBSC valuation standard is not only for the people who are practicing in the financial assets and securities, but also for the people who are practicing in the valuation of land and building, plant and machinery, inventory, real property interest, development property, and non-financial liabilities. And that is what is as far as the valuation standards are concerned. Let us now come to, friends, on the valuation conundrum or valuation demystified. I am sure, friends, if you pay attention when I am talking to you, the discussion that we have for next 3, 4, 5 minutes will make many things clear to you as far as valuation is concerned. And it will make all these things so clear that even if you want to forget, you will not be able to forget them. So, of course, given a choice, I would have loved to interact with you and ask you as to what you think is the value, what you think is valuation, and why valuation. But since we are in the virtual mode, sometimes it can be difficult, but we can try. So let me ask all of you to give me the answers as to what you think, and please be brief in your answers. Don't try to be, don't give me too long responses because we have a limitation of time. So all of you, I'm giving you time of 1 minute and 25 seconds. Let all of you, whoever is interested, to give me the answers to all these questions. What is value? What is valuation? Why valuation? What we find through valuation? What are the premises of valuation? And what is the business valuation process and how to do the valuation? So you have a time of 1 minute 25 seconds and your time starts now. Every one of you. All right, so not to worry. So what is value? सबसे पहले समझ के लेते हैं कि वैल्यू क्या है, वैल्यू का क्या मतलब है. And remember, it is very simple. What is value? Value is nothing but utility of an asset. Value is nothing but utility of an asset. An asset which has a utility will have a value. An asset or an object that does not have a utility will not have a value. And that is the first thing that we need to understand. Value का मतलब क्या है? Value का मतलब है utility of an asset. Number two, what is valuation? Again, very simple. Valuation is quantifying utility of an asset in money terms is valuation. So quantification of utility of an asset in money terms is valuation. And I'm sure you will very easily understand now as to what is valuation. Question number three, why valuation? An answer, of course, is very simple. We do the evaluation because we have to take a decision. In the corporate world, by now I am sure you would be fully aware as to what kinds of decisions are taken in the corporate world. And I am sure you can also visualize very easily. It is just impossible to take all those decisions in the corporate world without doing the evaluation. Whether you are taking a decision about organic growth or you are taking a decision about inorganic growth for the organization, in both the cases you will need to do the evaluation. Whether you are trying to enter into a collaboration with a new partner, or whether you are trying to do the marketing of the products of your company not on your own but by through an independent network of distribution, I'm sure you can take that decision only when you do the valuation. So why valuation? Valuation because we have to take a decision. And please remember, all of you as the future professionals, this is what is very, very important. Valuation is the tool in the hands of the corporate that enables them to take a decision. And I'm sure as we are discussing, and if you think about, you would come to the conclusion that any decision in the corporate world cannot be taken unless it is supported by a valuation. Question number 4, what we find through valuation? तो हम valuation के थ्रू क्या मालूम करने की कोशिश करते हैं? So through the process of valuation, we try to find out the fair value. Fair value is what we are always trying to find out. And what is a fair value? Fair value is the value which is between two parties, between two unrelated parties, and there is no other consideration other than the amount that is going to be paid by the buyer and the asset that is going to be transferred by the seller. Other than this, there is no other transaction, no other consideration. And that is what, and both the buyer and the seller are freely taking the decision. That means they are under no pressure, under no stress, under no coercion of any kind. So they are freely taking that decision. And that is what is your fair value. What are the premises of valuation? Very simple. Primarily, there are only two premises of valuation. अब premise का मतलब क्या है? Premise का मतलब ये है कि जब कभी हम valuation करते हैं तो उसके पीछे क्या situation होती है, and that is what is the premise. So there are only two premises. The premise number 1 is going concern. So normally we will do the evaluation of a company as a going concern. So the business is running, doing well. It is expected that it would continue to do well in future as well. And when you do valuation of a running company, the premise is a going concern. So premise is going concern. The second situation is that the company is now going to close down. So the company is going to close down. It's not a running company. It is a dying company. It is a dying company. And therefore the second premise, which is used for the purpose of valuation, is known as liquidation. Liquidation. When the company is going to close down, that is liquidation. So only two premises: going concern premise and the liquidation. Let us now understand the business valuation process and how to do valuation. Now, before we do that, let us quickly understand what are the opportunities available to valuation professionals under different statutes and what are the different categories of valuations. So number 1, please remember there's a first category of the valuation which is known as RV, registered valuers. Registered valuers are the ones who are either a cost accountant, chartered accountant, company secretary, or an MBA in finance, or anyone who is having postgraduate qualification in any other stream of finance and who has a 3 years of work experience and who has passed the valuation exam conducted by IBBI. So these are the people who are known as registered valuer, and these are the people who are registered as per section 247 of the Companies Act. As per section 247 of the Companies Act, at this point in time, please friends, remember section 247 of the Companies Act requires that any valuation which is to be done as per the requirements of the Companies Act, all such valuations have to be done by someone who is a registered valuer. That means someone who is registered with IBBI as a valuer. So that's number one, category number one. They can do the valuation of all the requirements under the Companies Act, and they can also do the valuation of all the requirements under the SEBI regulations. The second category of the valuer that you have is merchant banker, and I'm sure all of you know this. So a merchant banker can do the valuation, number one, for FEMA, he can do all the valuations. For the SEBI regulations, also he can do all the valuations. For the purpose of Income Tax Act, he is not fully authorized, only in certain cases, and I will discuss those cases with you. He can do the valuation as per the Income Tax Act. Then you have chartered accountants. Chartered accountants can do the valuation, all the valuation which are required under FEMA. Chartered accountants can also do valuations, some of the valuations which are required under the Income Tax Act. Chartered accountants cannot do the valuation which are required under the Companies Act, and they can also not do the valuation which are required as per the SEBI regulations. Unfortunately or incidentally, as it stands today, a company secretary or a cost accountant, as a company secretary or as a cost accountant, is not authorized to do valuation. But the same company secretary, same cost accountant, if he has passed the exam of IBBI, then he can of course do the valuation as I have just discussed with you, but that will be in the capacity of registered valuer and not in the capacity of a company secretary or a cost accountant, right? Okay. And the fifth category of the valuers is known as income tax registered valuers, ITRB, income tax registered valuers. So there is a section 34 AB in the Wealth Tax Act 1957, and as per this, a certain professional can get registered with the income tax department. And who can get registered? It is the cost accountants, company secretaries, and chartered accountants with 10 years of work experience. They can get registered with the income tax department, and then these people can do all the evaluations that may be required under the Income Tax Act. So this is just to give you an idea as to how and who can do the valuation under different statutes, as that is what our topic is. At the same time, remember, it is expected that going forward, the government is going to pass a legislation that would require that all the valuations are done only by a registered valuer. As a matter of fact, few years back, the government of India brought out a valuers bill. Unfortunately, it did not reach to the stage of becoming a law, and therefore that bill has become redundant. But hopefully going forward, the government will pass a law and will make a law in this country that all the evaluations, whether under the Income Tax Act, Companies Act, FEMA, SEBI regulations, Stamp Duty Act, or whatever, are all to be done by registered valuers only. Let us now, friends, come to the business valuation process. Now, before I start this discussion, business valuation process, let me throw this question open to every one of you for next 30 seconds. In case somebody would like to reply as to how should we the valuation process, or where would a valuation process start in case of any business decision. You have a time of 30 seconds. Your time starts now. Unfortunately or incidentally, I am not able to check the chat box also. So maybe Ashwin, you can play that role in case someone writes any question in the chat box. From time to time, Ashwin, you can read those questions, and I will take those questions.
Okay, sure, sir.
So you can tell me in case if somebody has already put some question in the chat box, I can answer those questions and then move forward.
Okay, sure, sir.
Okay, good. So this is how does the valuation process starts. So the valuation process starts from the understanding the purpose of valuation. So as I said little while ago, please remember, whenever you are taking a decision in a company or in a business for that matter, you will have to have a valuation. You cannot do the valuation unless and until you cannot take a decision until and unless you have done the valuation. So first thing is you have to identify as to what is the purpose, what is the decision that you are trying to take. So maybe you are trying to acquire a company, maybe you're trying to bring another investor into the company, maybe you're trying to split your company, maybe you're trying to merge your company with some other company. In all such cases or cases like this, you will need to do the valuation. So first step is in the valuation process is understanding the purpose, or understanding the purpose, or understanding the decision that you want to take. Thereafter, you identify the premise of valuation. So in case if you are talking about a company which is running company, going concern, so therefore the premise is going to be the going concern premise. Or in case if the company that you are talking about is closing down, then the premise is going to be the liquidation premise. Thereafter, you will need to determine the standard of value. So what is the standard of value? So primarily there are four standards of value. One is known as fair value. Fair value, as I explained to you, what is fair value. And then there is a fair market value. So what is the fair market value? Fair value is between two parties. That is fair value. Two parties come together and they decide the price. They agree to a price, that is fair value. What is fair market value? So you want to sell your car, right? So what you do, you just talk to a few friends of yours and tell them that I want to sell my second-hand car. Then somebody shows interest to you. You talk to him, both of you discuss, negotiate, and you come to a price. It is fair value. It is fair value because you agreed between two of you. What is fair market value? When you bring market into the picture while deciding the fair value, it becomes the fair market value. Now, see, for example, you wanted to sell your car. So instead of telling your friends that I want to sell my car, what you do, you go to on Spinny or on Car Dekho or on these portals which help you sell these second-hand cars. So you talk to the Spinny people and tell them that I have this model that I want to sell, and the Spinny people run their own auction, and they realize, they come to a price and they tell you that this is the price that we can offer. So now this it becomes fair market value. Then you have a specific value. A specific value would mean that the value of an asset will depend on the person who is buying, and that is your specific as value. And finally what you have is known as intrinsic value. And what is the intrinsic value? Intrinsic value is nothing but discounted cash flow, present value of present value of future cash flows, and that is your intrinsic value. So you will also need to determine as to what is the standard of value that you will need to take, and that will depend on situation to situation. Thereafter, of course, all of us are the corporate professional, and as corporate professionals, obviously we would be engaged where the decisions that are to be taken are going to be big in size, and therefore when you want to do the evaluation, so you will have to do the information collection and the data analysis. Say for example, if you're trying to, if tomorrow, let's say Infosys or Wipro or TCS, in case if they decide to acquire a company in Europe or in America, which is going to be of the size of few $1 billion. So obviously, if they have to arrive at the value of this American company or European company, what TCS, Wipro or Infosys will have to do, they will need to gather a lot of information, lot of data, do the analysis of those information and data for the purpose of arriving at the valuation. The fifth step in the valuation process is selection of appropriate valuation approach and method, right? So approach, I'm sure you would remember, we discussed approach can be income approach can be market approach can be the cost approach, which is also known as asset approach. And under these approaches, there are different methods which I'm going to share with you. And based on this, you determine the value. And this friends is the valuation process which is followed everywhere across the globe. So please remember, a good thing for all of you, when it comes to valuation, so the principles and the practices of valuation do not vary from geography to geography. The practices and the principles of the valuation are all same all over the globe. So there are only three approaches: income approach, market approach and the cost approach in India. Same is the case with America, Europe, Russia, Asia, New Zealand, Australia, Japan and everywhere actually. And that is what is something. That means if you understand valuation in India, that means your same understanding about the valuation that you have about India will hold you good in the rest of the world also. So Ashwin, let me throw it open to every one of you for another 30 seconds in case somebody has a question, and in case if he is writing in the chat box, you can please read it out and I will answer that question.
Yes, sir.
Okay, so now let's look at some of the purposes of valuation. So remember, as I said earlier, valuation is a very important tool for in the hands of the corporates for the purpose of decision making. So whenever you have to take a decision, you have to do the valuation. So what are the purposes? And remember, what I'm discussing with you is not an exhaustive list of the purposes for which you will do the valuation. This is only an indicative list. This is only an indicative list just to give you an idea as to what kind of decisions are taken in the corporates and how the valuations are used in taking those decisions. So the purpose of valuation can be transactions, and within the transactions it can be corporate restructuring, mergers and amalgamations, IPOs, buyback, sale or purchase of assets, tangible or intangible. Compliances, so we may require valuation for the purpose of compliances as per the FEMA, as per the transfer pricing, as per the income tax or as per the SEBI regulations. We would also require valuation for the purpose of financial reporting, and I'm sure, as I was discussing with you, when it comes to the financial reporting, particularly the Indian accounting standards or IFRS or US GAAP, you have to do the financial reporting, and for the purpose of financial reporting you need to obtain valuations in many cases. So for example, impairment testing, right? So India is 36, which is on the impairment requires an entity to test its assets on the balance sheet dates for impairment. So how do you do that? For the purpose of impairment testing, you need to do the valuation. Purchase price allocation. So India is 103, which is on business combinations. So India's 103 on business combinations. As per India's 103, if you acquire a company and you are paying a consideration, so the consideration that you are paying to the seller of the company or the transferor of the company which you are acquiring, you will need to allocate the consideration that you have paid to the transferor company. You will need to allocate that consideration on all the assets that you have got as part of the business combination. Also, the fair value reporting would be required, as I said a little while ago, and as per the IFRS, as per the US GAAP, and also as per the Indian accounting standards. Valuations are also required for the purpose of settling the litigations. So, bankruptcy, as we will discuss as we move forward, shareholders disputes, right? So, I'm sure all of you would remember. I would not call it as a dispute, but I'm sure many of you would remember when our legendary businessman Shri Dhirubhai Ambani, when he passed away after his said demise, two brothers Mukesh Ambani and Anil Ambani somehow were not interested to stay together and decided to part ways, and that required the entire Dhirubhai Ambani empire to be divided between two brothers. And how that division was done? The division was done by doing the valuation. So that means all the businesses which Dhirubhai Ambani owned before his said demise, all those valuations were, all those businesses were valued, and then they were divided between the two brothers. So valuation is also for the purpose of shareholders dispute. Marital dissolution, so so shadi, divorce and all those kind of things, when they happen, how do you settle them? Because if the assets have to be divided, whether in case of marital dissolution or in case of family settlement, again you will need the valuation. So these are some of the purposes I thought to share with you where you would need to do the valuation. Let us now, friends, move to the next topic, and that is business valuation approaches and methods. So again, Ashwin, anyone with any question that someone has posted in the chat box, you can please read it out. I can take it now before I start with the approaches and methods.
No questions, sir. Now, till now, everything is clear, I think.
Okay, very good, very good. Right, friends. So obviously, this is the heart and brain of valuation. And I'm saying, when I say heart and brain, that means you can understand how important is the approaches to valuation and the methods to valuation. And that is what now we are covering. So first of all, is what you have is income approach. I have explained to you. Under the income approach, there is a method which is known as income capitalization method, and there is another method which is known as discounted cash flow method. Now, what is income capitalization method and what is discounted cash flow method? How do they differ? Let's understand. Under the income capitalization method, what you do? You have to do the valuation of XYZ Limited. Now, how do you do the valuation of this company based on the income capitalization method? So this is the company which has consistently been making profit, and it is expected that this company would continue to make profit in future also. So one way of doing valuation of this company following the income capitalization method is you take the past data. That means you take the figure of income of this company in past years, and using the past income, you decide the value of this company, and that is why this is known as income capitalization method. So you try and find out the average profit this company would earn in future, and assuming a cost of capital. So when I say assuming, that means finding out your cost of capital, you capitalize the profit that is expected to be earned from this entity in future and find out the value of this entity. In case of discounted cash flow method, you don't use the past income details. You rather you find out the projected cash flow or projected income of this entity. And that is the prime difference between the income capitalization method and the discounted cash flow method. In case of income capitalization method, you will use the past data. In case of discounted cash flow method, you will use the future information. So when you want to do the you do the valuation using the discounted cash flow method, what will you do? You will project the future income of this company and discount those future cash flows by the cost of capital of this company to find out the present value of all the future cash flows, total of all the future cash flows, the total of present value of all the future cash flows put together. becomes the value of the entity. So this is your income approach. Under the market approach, you have three methods. Number one is quoted price, and I'm sure you will remember when I was discussing with you about Ind AS 113. So Ind AS 113 talked in terms of level 1 input and it talked about the quoted price. तो अगर आपको एक कंपनी का वैल्यूएशन करना है using the market approach, quoted price becomes the basis for you to decide the value of that company. If company is not listed on a stock exchange, then what do? Then you use the comparable company method, and that is where you have these things called multiples. I'm sure you must have heard of these multiples. So comparable company method, that means what? That means you try and find out, if you're trying to do the valuation, as I explained to you already, if you're trying to do the valuation of XYZ is not listed, ABC is listed, ABC is comparable with XYZ. So using the multiples, different multiples, EBITDA multiple, net profit multiple, and operating profit multiple, sales multiple, you can determine the price of the company ABC that you're trying to value, and that's your comparable company method. Then you have a comparable transaction method. So now what you're doing, you're not trying to do the valuation of a company, you're trying to do the valuation of a transaction. Say for example, you go to a new city, and in that city you want to purchase a new house. So when you want to purchase a new house, you have to pay a price. So before paying that price, before coming to the conclusion as to what price you must pay, what you will generally do, you will go in that locality, in that area, and meet some non-people and ask them as to, if I purchase in this locality a flat, how much should be the price that I must pay? Then somebody might tell you that in my knowledge, somebody sold a flat here a week back and he paid so much of price. So what someone paid a week back, that is the comparable transaction method. So this is how you will do the valuation using the comparable transaction method. So what is the difference between the comparable company method and the comparable transaction method? The difference is comparable company method is for the valuation of a company, and comparable transaction method is for the valuation of a transaction. Then the third approach is asset approach or the cost approach. Please remember, you call it asset approach, you call it the cost approach, both mean the same thing. And why I'm telling you this, and that is because whenever you will be reading any financial literature on the valuation, sometimes they would refer as asset approach and sometimes they would refer as cost approach. So at that time you should not get confused thinking that these two approaches are different. No, these two approaches are not different. They are both same. They are used, these terms asset and the cost are used interchangeably. So under the cost or the asset approach, there is the first method which is known as book value method. Now what is book value method? The book value method is very simple. So you want to do the valuation of a company. So how do you do the valuation of this company? You will do the valuation of this company by picking up the balance sheet. आप बैलेंस शीट को उठाएंगे और बैलेंस शीट में जो जो फिगर दिए हुए हैं आप उन फिगर को लेंगे. So you will take the total of the assets and you will take the total of the liabilities, and from the total of the assets you will deduct the total of liabilities, and that will be your book value method. In simple words, how does the book value method works? So you just pick up the figures given in the book and use them for the purpose of valuation, and that is what is your book value method. Then you have an adjusted book value method. So what is the adjusted book value method? You pick up the balance sheet, remember, but what you do, you don't take the amount of different assets and the liabilities which are given in the balance sheet. You make adjustment in those amounts. Let's say for example, you want to do the valuation of again XYZ. You pick up the balance sheet of XYZ, and when you look at the balance sheet of XYZ, you see an item called land showing as 1 crore. Now remember, this company XYZ purchased this land 10 years back for 1 crore. Now today the market value of this land is not 1 crore, it is 50 crore. So therefore, when you want to do the valuation of a company based on the adjusted book value method, what you will do? You will not take the value of the land as 1 crore. You will take the value of the land as 50 crore when you are doing the valuation of XYZ. And that is how it is known as adjusted book value method. Number 3 is the replacement method. So what is replacement method? So the asset that you're trying to value, if this asset is to be replaced in the condition in which it is today, how much money you would need to spend, and that amount becomes the replacement value. Please remember, replacement value does not mean how much you will have to pay for buying a new asset to replace this existing asset. No, it only means that this existing asset, if it is to be replaced in the same condition as it is, अगर उसको नया बनाना है उसी कंडीशन में जिसमें कि वो आज है, तो कितना खर्चा होगा, and that is known as your replacement method. And finally is your liquidation value method. So what is liquidation value method? Liquidation value method, of course, is very simple. The company is closing down. It has got no future potential. It has no possibility of getting revived, and therefore it has to be sold. So liquidation value would mean that what the amount that you realize from the sale of the assets minus the expenses that you will incur in selling those assets, and from whatever remains you deduct the liabilities that you have to pay, and whatever remains, if any, that is known as your liquidation value. So these, friends, are the 3 different approaches and different methods under those approaches. Any question from anyone?
No, sir.
Okay, good. So friends, what we have discussed and understood is the approaches and the method for valuation. Now, how do you connect it with the valuation hierarchy? So this quoted price is your label 1 input. This comparable company method or comparable transaction method is your label 2 input, and the discounted cash flow is based on your label 3 input. And let me also share with you something more important here, friends, and that is, remember, discounted cash flow method is the most fundamental, dependable and reliable method for valuation. So जब भी आपको कंपनी कोई डिसीजन लेना है आपकी कंपनी में और आपकी कंपनी का वैल्यूएशन करना है, तो always remember that you must always base it on the discounted cash flow, because that is the most dependable, reliable, fundamental method used globally. पूरी दुनिया में सबसे ज़्यादा जो मेथड वैल्यूएशन के लिए यूज़ करती हैं कंपनियां all over the globe is the discounted cash flow method. The quoted price method is okay for the purpose of valuation, but it should be cross-checked with the discounted cash flow method. Say for example, now 3-4 days back, what were the stock prices of different companies in this country, and what are they today? So suddenly, within a short gap of about 2-3 days, the stock prices on the stock exchange have crashed down. So does it mean that the value of those companies have really gone down so much? And I would say no. But if you strictly follow the level 1 input and the quoted price, then you will come to the value of those entities based on the current quoted price. So technically that may be correct, but really speaking, the value of those companies are still intact. It's just a matter of time. Whatever tantrum which the President Trump has thrown about the tariffs all over the globe, in my view, this matter is going to settle down not more than within 2-3 weeks. So within 2-3 weeks, this issue of the tariffs is going to be settled down. So what is going to happen? The stock prices all over the world which have gone down will bounce back to their real value, and that real value comes from the discounted cash flow method, and that is what I thought you should remember. The asset approach, remember, is good mostly in case of liquidation. So the liquidation, the asset approach or the cost approach gives you valuation which is an indicator of the downside. That means what is the minimum, that you must be prepared to what is the max. So if you're a seller, the cost approach will tell you what is the maximum that you should be prepared to accept. If you are a buyer, then you should be prepared to pay minimum, that is what you arrive based on the asset approach or the cost approach. Now the question is, when do you use the discounted cash flow method? Will someone like to answer this question? Let me throw it open to you for 15 seconds. In case somebody would like, you can unmute yourself and you can speak up. When and where the discounted cash flow method can be used? Right. So friends, discounted cash flow method can be used every asset that has the capability of independently generating cash flow. All such entities, all such companies can be valued based on the discounted cash flow method. Just to give you the full picture, there are basically three classes of valuation, three asset classes of valuation. The first asset class is securities or financial assets. That's the first class of the assets that require valuation. The second class of the assets that require valuation is land and building. And the third class of the assets that require valuation is plant and machinery. Under the securities or financial assets, as a valuation professional, what are the assets that you would be doing valuation of? So number one, you will be doing the valuation of businesses and equity. That means you will be doing the valuation of a company, or you will be doing the valuation of equity share of a company. You will also be doing valuation of intangible assets. And friends, here as the corporate professionals, I would like to share with you, most people think that globally companies are run on the strength of tangible assets, and which is completely wrong. Globally, all the businesses which are run, remember, they are run on the strength less of the tangible assets. They are run more on the strength of intangible assets. As much as all the corporates all over the globe have many intangible assets, but they are not even reflecting on the balance sheets of those companies. So and why they are not reflecting on the balance sheets of those companies, and that is because an asset will appear in the balance sheet of a company only when the company has paid for it. So if you create brand name for yourself over the years, now the value of this brand name will not come in the balance sheet of yours. But tomorrow, if your company is sold to someone, then that someone will have to pay you for the brand value that you have created. So as part of the securities or the financial assets, you also do the valuation of intangible assets. You do the valuation of fixed income securities, you do the valuation of derivatives, and you do the valuation of other financial assets and liabilities. So please remember where and when discounted cash flow method can be used for the purpose of valuation, and that is as and when there is an entity which can generate its own cash flow independently. The discounted cash flow method can be applied in all such cases. Let's now come to the next aspect of our discussion, and that is techniques of different type of corporate restructuring and importance of valuation. So different types of corporate restructuring and the importance of valuation. Now I want to ask this question to all of you, and I want at least 2-3 answers to come. What is corporate restructuring and why companies resort to corporate restructuring? Every one of you.